Welcome back, focused learners. Okay, so today we're tackling a foundational truth of personal finance. Wealth isn't just about making money. No, lasting wealth is actually preserved by carefully managing risk. Think of your finances kind of like constructing a sturdy house. If you build it well, it's going to weather absolutely any storm. But if you ignore the structural integrity, a single bad event can literally tear the whole thing down. So in today's explainer, we're going to explore the ultimate blueprint for protecting your hard-earned money and building a really resilient financial future. Okay, let's dive right into this. Picture an investor, let's call him Investor A. He's a student in Accra who goes completely all in, putting 100% of his savings into cryptocurrency. Now contrast him with Investor B, who intelligently spreads her money across stocks, bonds, real estate, cash, and just a tiny bit of crypto. When the crypto market inevitably takes a massive 70% nosedive, ouch, that student in Accra loses almost everything. But Investor B, well, she takes a small hit, sure, but her overall portfolio easily survives the storm because her other assets completely balance out the damage. That, right there, is the magic of diversification. So here is our blueprint for today's explainer. 1. The reality of risk. 2. Meet the asset classes. 3. Layers of diversification. 4. Building your first portfolio. And 5. Long-term wealth protection. Let's get right to it. Section 1. The reality of risk, building the foundation. Just imagine a Lagos trader who puts absolutely everything into imported rice, only to be totally ruined by a single unpredictable policy change. That is concentration risk in a nutshell. Which naturally brings us to a question I hear from beginners, honestly, all the time. Lean in for this one because it's probably the biggest mental hurdle people face. They always ask, can I invest without risk? The honest, hard truth? No, you absolutely cannot. Risk is just baked right into investing because, well, the future is completely uncertain. Governments change, businesses fail, global events just happen out of nowhere. But here is the real kicker. Even doing nothing is risky. If you just leave all your money sitting in a basic bank account, you face the silent, invisible risk of inflation. Think about it. If your bank pays you 5% interest but inflation is running at 20%, your purchasing power is actively being destroyed. Successful investors don't avoid risk, they manage it. Moving on to Section 2, meet the asset classes, your building materials. You wouldn't try to build a house using nothing but cement, right? So you definitely shouldn't try to build wealth with just one asset. Now, what's really interesting is the clear relationship between risk and reward. Think of cash and bonds as your low-risk, low-return anchor. They give you stability. Then, as you step up to real estate and stocks, you're taking on moderate to high risk, but you're getting much higher potential returns. And way out there on the edge, cryptocurrency sits at very high risk and very high potential return. This whole setup acts like a balanced financial diet. You need the stability of those low-risk assets to anchor you and the growth of the high-risk assets to outpace inflation. It's all about balance, you know? Section 3. Layers of diversification reinforcing the walls. True protection means spreading your risk out even within your asset categories, using really cool modern tools like fractional shares and ETFs. Here is a massive trap so many investors fall into: home bias. It feels super safe to invest only in the country where you actually live, right? But it's incredibly dangerous to tie your entire financial destiny to just one country's economy. If local inflation spikes or the currency devalues, your wealth just evaporates. Global diversification, on the other hand, acts like an invisible shield. By holding international stocks or dollar-denominated assets, you protect your purchasing power no matter what crazy stuff happens in your local economy. Okay, Section 4, building your first portfolio, constructing the house. Now we're shifting from theory into practical application. Let's actually design a portfolio. Let's walk through this actionable blueprint step by step. First up, define what you're actually investing for. Is it a car in 3 years or retirement in 30? Second, and please do not skip this, build an emergency fund with 3 to 6 months of living expenses so you never have to sell your investments in a blind panic. Third, figure out your asset allocation. And fourth, start small and stay consistent. You literally do not need millions to start investing. Consistency, combined with the absolute magic of compound interest, will do all the heavy lifting for you over time. So the crucial point is figuring out that allocation. Let me introduce you to the 100 minus age rule. It's a brilliant starting point. Actually, scratch that. It's more like a genius rule of thumb. You simply subtract your current age from the number 100, and the result is the percentage of your portfolio that should generally be invested in higher growth, higher risk assets, like stocks. So if you're 30 years old, 100 minus 30 is 70. That means you'd aim for roughly 70% in stocks and 30% in safer stuff like bonds and cash.
Let's bring this to life with an example. Meet Amina. She's a 28-year-old teacher in Abuja with some solid long-term growth goals. Notice how she carefully balances her assets. She's got 50% in stocks for aggressive growth, but it's completely anchored by 20% in stable bonds and 15% in real estate. She keeps 10% in cash for absolute liquidity and limits her highly volatile crypto exposure to just a tiny 5% sliver. It's balanced, it's logical, and it's perfectly tailored to her exact life stage.
And finally, Section 5, long-term wealth protection, maintaining the house. Because building wealth is only half the battle, right? Preserving it through discipline is what actually creates lasting financial freedom.
Let's move to the timeline and see how this builds over the years. You absolutely have to match your investments to your time horizon. If you need the money in 1 to 3 years for school fees or rent, keep it in cash or treasury bills. Literally do not put short-term money in the stock market. For 3 to 7 years out, start looking at bonds. But if you don't need that money for a decade or more, well, that is when you unleash the long-term wealth-building power of stocks and real estate. Now, over time, your carefully planned house is going to start to shift. Let's say you started with 50% of your money in stocks. After a really massive year in the market, those stocks blow up and suddenly make up 70% of your portfolio. You are now accidentally taking on way more risk than you intended. This is what we call portfolio drift. To fix it, you have to rebalance, basically selling off some of those winners and buying more of your safer assets to force that allocation right back to your original 50% target. It keeps your risk strictly controlled.
Of course, there are always traps along the way. Let's rapid fire through the most common emotional mistakes that totally destroy wealth. Number 1, concentration, putting all your eggs in one basket. Number 2, chasing trends. Listen, if your uncle and everyone on social media is telling you to buy a meme stock out of FOMO, yeah, you're probably already too late. Then there's over-diversifying, which just creates a chaotic mess of fees. Speaking of fees, ignore them at your own peril. They compound over time just like interest does. And finally, emotional panic selling. Discipline and a cool head are, for sure, far more valuable than a high IQ when the market starts bouncing around.
I really want to leave you with this incredibly powerful thought from our source material today. Wealth grows through opportunity, but it survives through diversification. Think of your diversified portfolio kind of like a deeply rooted tree. The wider and deeper the root system spreads across different assets, sectors, and countries, the stronger it stands. When the economic storms roll in, and trust me, they definitely will, a shallow tree snaps in half. But a deeply rooted tree, it barely even sways. So, I'll leave you with this final question to chew on today. Take a really hard look at your own financial life right now. Is your financial future depending entirely on a single currency, a single job, or a single investment? Because if the answer is yes, well, you know exactly what you need to do. Start spreading those roots today. Thanks for learning with us, and we'll see you in the next explainer.